Welcome back. Today's explainer is basically your premium survival guide for the future economy. We are tackling a massive question, the future of money. What happens next? We're going to take this wild journey from the microscopic details of your very own wallet all the way up to those massive systemic global collapses that literally reshape societies. Look, we live in a world of high debt and insanely rapid technological shifts. Understanding how money flows, how it grows, and how it occasionally just vanishes, that's the only way to protect yourself.
All right, here's our roadmap for today. 1. Your financial foundation. 2. The balance sheet. 3. Decoding the stock market. 4. Quants, AI, and funds. And 5. Surviving the next collapse. Okay, let's dive into this.
Section 1. Your financial foundation, mastering the micro. Before we can even touch on global markets or AI trading algorithms, we absolutely have to anchor ourselves in the one thing we actually control, right? Our own money. Because you literally cannot master the macro if you haven't mastered the micro. Enter the 50-30-20 budgeting rule. It's the ultimate tool to make sure your money doesn't boss you around. It breaks down like this. 50% of your take-home pay goes to fundamental needs: rent, groceries, the basics. 30%, that's for fun spending, because hey, life is meant to be lived. And that last 20% is fiercely protected for your future: savings, investments, and extra debt payments. Establishing this numerical anchor stops you from drifting aimlessly and gives your income clear, actionable instructions.
But what if you've got debt? We know not all debt is bad. Mortgages and student loans can build your future. But high-interest consumer debt? That's an absolute wealth killer. To crush it, you've got two proven strategies. The debt avalanche method targets your highest interest rate debt first. Mathematically, it's the most efficient way to save cash. But then you have the debt snowball method. This one completely ignores the interest rate and attacks the smallest balance first. Why would you do that? Because knocking out a loan completely gives you this massive psychological win. Honestly, you just have to choose the strategy that's going to keep you motivated.
And speaking of debt, let's talk about one of the biggest wealth killers out there: cars. Transportation can easily eat up 20% of a person's income if you aren't careful. If you're going to finance a car, you absolutely need to follow the 24/10 rule. That starts right here, with a minimum 20% down payment. You then finance the car for no more than 4 years, and you keep your total transportation costs under 10% of your monthly income. Do this, and you stop yourself from draining your hard-earned wealth on an asset that plummets in value the literal second you drive it off the lot.
Section 2. The balance sheet, the architecture of wealth.
Now, what's really interesting about this is that if we step up from the kitchen table to the corporate boardroom, the exact same logic applies. The financial health that guides you at home dictates the survival of billion-dollar companies. It's all about architecture, and the ultimate bedrock of all business accounting is the balance sheet. Think of it as a high-definition photograph of a company's financial health captured at one specific moment in time. It is built entirely on the golden rule that assets, everything the company owns, will always equal its liabilities, what it owes, plus equity, which is what's left over for the owners. Every single dollar has to find a home in this elegant equation.
Let's zoom in on the assets side of that equation. You'll notice a clear split between current and non-current assets. Current assets, those are all about short-term liquidity. We're talking cash, inventory, things you can quickly convert to money within a year, just to keep the lights on and daily operations running smoothly. Non-current assets, though, are your heavy lifters for long-term value generation. Think property, heavy equipment, even patents. A healthy company absolutely needs a perfect balance of both to survive today and actually grow tomorrow.
Section 3. Decoding the stock market, stocks, indexes, and funds.
So when a company wants to grow its assets, maybe build a new factory or invent a new product, it needs capital, right? So it sells pieces of itself to the public. That piece is a stock. But as we all know, picking individual winning stocks is brutally hard. That is exactly why funds exist. Let's compare two absolute titans of everyday investing. Mutual funds are actively managed by professionals trying to pick winners and beat the market. Because of that, they charge higher fees, sometimes upwards of 1.5%. Index funds, on the flip side, are passively managed. They just copy a list of companies like the S&P 500, meaning fees are literally fractions of a percent. Historically, consistently beating the market is super rare, which is exactly why financial legends like Warren Buffett constantly recommend low-fee, passive index funds for the everyday investor.
And then you have hedge funds. This is a completely different universe.
We're talking private, aggressive, actively managed portfolios restricted strictly to wealthy, accredited investors. They use complex strategies like short selling and leveraged, borrowed money to chase massive returns. Because they're hunting for such crazy high rewards, they charge the infamous 2 and 20 fee structure. That's a 2% management fee plus 20% of all profits. It's a high-stakes environment entirely disconnected from your basic, accessible retirement ETF.
Section 4. Quants, AI, and Funds, the algorithmic edge.
All right, we're leaving human stock pickers in the rearview mirror now as we pivot to the absolute cutting edge of finance. We are entering a space where humans and machines team up to hunt for entirely new revenue streams before the rest of the market has even had its morning coffee. Welcome to the world of quant trading. Basically, this is the systematic application of advanced math and AI models to financial markets. Gut feelings, traditional chart reading, gone, replaced by massive data processing. It is this insane high-pressure team sport where researchers invent algorithms, developers build the trading infrastructure, and traders execute high-speed risk management. And they aren't just trading stocks, they are hunting for mathematical outliers across gold, crypto, natural gas, you name it.
And this brilliantly illustrates just how deep the rabbit hole goes. Even early-stage venture capital is becoming algorithmic. A quant VC doesn't sit around waiting for a startup pitch. Oh no, their machines are out there scraping open-source platforms like GitHub to see who's writing the most influential AI code. Or they're plugged into Shopify APIs to see what secret new product is suddenly flying off the digital shelves. They aggregate all this data, and their AI automatically scores and ranks the founders. The math literally finds the next billion-dollar company before a human even shakes hands.
So what are the algorithms actually looking for? Mostly companies capitalizing on the massive AI wave. Right now, AI is acting as a ridiculous catalyst for new wealth generation, mainly across 3 specific buckets. First, services like education and medicine are getting 10x faster and cheaper. Second, we're seeing completely new user experiences that redefine how we interact with software. And third, human creativity, coding, writing, video production is getting a 100x productivity boost. AI is quite literally eating the software world, and the quants are indexing the whole shebang in real time.
Section 5. Surviving the next collapse. The final stage illusion.
So the crucial point here is understanding the macro level. While massive tech leaps and bull markets create unbelievable wealth, they can also completely mask a rotting economic foundation. Debt expands, asset prices inflate, and suddenly the system isn't running on cash anymore. It's running on pure confidence. Just let this thought sink in. A financial collapse is rarely a lightning strike. It is more like a water tower that has been draining for months. It's chilling, right? When a system survives on delayed recognition, when the promises inside the system become infinitely larger than the actual cash flow supporting them, leaders will use calm words and technical policy to basically paint the water tower, just hoping nobody notices the tank is actually empty.
And history shows us this eerie repeating pattern. In 1997, Thailand's currency peg broke, devastating companies holding dollar-denominated debt. In 2001, Argentina literally froze bank accounts. 2008, the U.S. housing market completely buckled under the weight of weak loans dressed up as safe assets. Fast forward to 2015, and Greece is shutting bank doors. Now you have to understand, these weren't random events. They were all the final acts of managed illusions. The collapses didn't actually start on these dates. These were just the exact moments when the hidden weakness lost its ability to hide, and private failures suddenly became a very public humiliation.
And when that illusion breaks, it is always the everyday citizen who pays the price. 250. During Argentina's 2001 crisis, the government enacted the Corralito, placing a maximum weekly withdrawal limit of just 250 pesos on citizens' own bank accounts. Can you imagine? Playing by the rules your entire life, maybe you're a pensioner, and suddenly a government decree traps your life savings behind a legal wall? A macro crisis that begins way up in high-level balance sheets always violently impacts a normal person's kitchen table. Which brings us to a really harsh, impartial reality. Financial collapses do not destroy evenly. They redistribute wealth. The losers are very often prudent, middle-class savers. They're the rule followers with highly concentrated wealth in local banks or folks holding highly leveraged, depreciating assets. On the flip side, the winners, historically speaking, are the well-connected. They're highly flexible, maybe holding foreign reserves, or they possess hard, productive assets. Basically, when the floor opens up, the careful citizen standing still is usually the one who falls in.
But listen, you absolutely do not have to be a victim here. By studying the people who survived these historical crashes, we can pull out some clear, powerful rules to protect our own wealth when the next bubble inevitably bursts. First up, respect liquidity. Never confuse a paper statement with actual, usable control over your money. Second, avoid concentration. Diversify across assets and, yes, even different banking institutions. Third, develop adaptable skills that keep you tethered to the productive, real economy. And finally, be psychologically early. Stop treating stability like it's a permanent feature of the world. Start reading calm, technical language from leaders as a blinking warning sign.
So we've gone from the 50-30-20 rule in your personal budget, navigated through the AI-driven world of hedge funds, all the way to the anatomy of historical bank freezes. And it all circles back to one absolute truth. You have to take control of your balance sheet before the macroeconomy takes control of you. So I'm going to leave you with this question. Are you actively building a resilient financial foundation, or are you just coasting on the managed illusion? Take a really hard look at your numbers today. Thank you so much for joining us on this explainer, and we will catch you next time.